On April 15th, the Silver Institute quietly released its 2026 World Silver Survey, and the numbers buried inside it are staggering. For the sixth consecutive year, the global silver market is running a structural supply deficit. The projected shortfall for 2026 is 46.3 million troy ounces, a 15% widening from last year's deficit. And since 2021 alone, roughly 762 million ounces have been quietly drained from above-ground global stocks. Less than 24 hours later, spot silver violently spiked to $83.57 an ounce intraday. The dollar index slid to a 6-week low of 98.20, and the March CPI print came in hot at 3.3%. This is not a coincidence. The paper silver market is beginning to fracture under the weight of a physical squeeze that institutional players have seen coming for years, and most retail investors are still completely unaware. Now, to put this in perspective, silver hit an all-time record of $121 an ounce in January of this year, before the CME Group hiked initial margin requirements to 15%, forcing a violent liquidation of leveraged paper positions. That margin hike was the first warning shot. It exposed the fundamental fragility of a market where derivatives contracts vastly outnumber the physical metal that supposedly backs them. And the consolidation we've seen between $70 and $85 since then is not weakness, it is accumulation. We can see this clearly in the investment flows. Physical bar and coin demand is forecast to rise 18% in 2026 to 227 million ounces, the strongest level in 3 years, and silver-backed ETP net investment tripled in 2025 as institutional capital rotated in. So the question is, why now? The answer is the industrial choke point. Unlike gold, silver is consumed. Roughly 60% of all silver demand comes from industrial applications that cannot pause and cannot easily substitute. Solar panels, electric vehicles, defense electronics, AI data centers. These are the bottlenecks of the most tightly supplied markets on Earth. Now, the optimists will tell you that solar manufacturers are thrifting silver out of cells, and they are right. The 2026 forecast shows solar silver demand falling roughly 19% as Chinese producers like Longai push toward copper-based pastes. But this ignores the floor underneath the entire market. Global defense spending hit a record $2.63 trillion in 2025, and military avionics under mil-spec QQ-S-365 cannot substitute silver because failure means loss of mission or loss of life. AI infrastructure is driving demand for high-density circuit boards at rates 15 to 20% above traditional electronics. In other words, the price-inelastic demand floor is rising even as the price-sensitive demand softens, and over 70% of mined silver comes out of the ground as a byproduct of copper, lead, and zinc mining, which means supply cannot respond to higher prices. Global mine production peaked in 2016 and has been falling ever since. Now, this is where the geopolitics collides with the physics. Since January 1st, China has required formal authorization for outgoing silver shipments, with only 44 companies approved for export through 2027. In just the first 2 months of 2026, China imported over 790 tons of silver, with 470 tons pulled in February alone. This is the largest consumer of industrial silver on Earth, simultaneously hoarding inventory and restricting exports. And it is happening exactly as Western vaults are running thin. The October 2025 London liquidity squeeze was the first public preview of what happens when paper meets a depleted physical floor. The reality is that the US government has already acknowledged this vulnerability. The Department of the Interior added silver to its critical minerals list in late 2025, launched a $12 billion initiative called Project Vault, and on April 16th, the House Agriculture Committee held a hearing on the Silver Act addressing the geographic concentration of precious metals depositories. When governments start writing legislation about supply chain security for a metal, the structural shortage is no longer a theory. Now overlay the macro backdrop. The dollar index has fallen roughly 10% since the start of President Trump's second term. The Federal Reserve faces unprecedented political pressure as the March CPI print blew past forecasts, and gold has been ripping toward $5,000 an ounce, with JP Morgan now targeting $6,300 by year end. The gold-to-silver ratio has compressed from 107 to 1 in April of last year to roughly 61 to 1 today. Believe it or not, that compression is the violent catch-up trade, and it is far from finished. History is the proof. From December 1969 to December 1979, through the last great stagflation cycle, silver returned 1,546%. a compound annual growth rate of 32.3%, outperforming gold by over 5 percentage points per year. The current setup, negative real interest rates, hot CPI, a softening dollar, and a structural supply deficit running for the sixth consecutive year, is not a partial echo of the 1970s. It is a more concentrated version, because today, the industrial demand layer did not exist back then. So this is the picture. A 6-year structural deficit, 762 million ounces drained from vaults, China hoarding and restricting exports, defense and AI demand that cannot substitute, a fragile paper market already exposed by margin hikes and liquidity squeezes, and a macro backdrop that historically delivers double-digit annualized returns in this exact metal. The trading desks already know. The question is whether the average investor recognizes the setup before the next repricing event closes the window. Thank you for watching.